A lot's been said about the ILFS default and the rising liquidity concerns, but I think it's important to differentiate between the wheat and the chaff. There are NBFCs as a space has corrected. There are some which may not be impacted as badly. And I think, therefore, what Shraddha is talking to us about, it becomes very, very important. Shraddha, not everybody loses out. We are not out here to say that these stocks might be great buys, but just to dissect that some will be impacted more negatively than others, isn't it? Yes,
absolutely, Neeraj, that's true. And we will see which other NBFCs which seem to be better placed currently. But before that, why has this entire ILFS issue, the mutual fund risk aversion and liquidity tightness become so important for NBFCs? Two data points that I want to share. One is from a UBS report which says that mutual funds have deployed 17% of their debt AUM in NBFCs. And second thing is Credit Suisse report which says that over 40% of the NBFC debt papers are due for refinancing in the next 6 months, and that's a sizable number. And that is why this, this entire issue becomes important, because if mutual funds are not keen to rule over the commercial papers that mature in the near term, it could expose some of the NBFCs to refinancing and repricing risk. So let's see which are the NBFCs which actually have a huge dependence on market borrowing. So market borrowings could either be CPs or NCDs, so that's the short-term and long-term borrowing. It's LIC Housing Finance, India Bulls Housing Finance, Mahindra Finance, Bajaj Finance, PNB Housing, a lot of housing finance companies which have a market borrowing which is more than 50% of their total borrowings. Having said that, it is more important to focus on and understand what the ALM gap is, which means the asset liability mismatch, and we are looking at the less than 1 year bucket here right now. A positive gap is a good thing. So in case of Bajaj Finance, Shriram City Union, Mahindra Finance, Edelweiss, all of them have a positive gap, which is a good thing. It actually means that they have more assets which are maturing in in less than 1 year than liabilities, and hence the assets itself will be able to fund the liabilities and they won't be exposed to refinancing risk. On the other hand, if you look at Repco Home, Canfin Homes, they have a negative gap of 29-25%. Diwan Housing, LIC Housing, PNB Housing also have negative gaps. So a lot of housing finance companies are the ones which have a negative gap, which means that they will have to replace the short-term maturing liabilities at a much higher cost, and that could possibly have an impact on the spreads, and not just spreads but also growth rates, because in the absence or in the difficulty of funding or a higher cost of funds, these guys might want to moderate their cost. Having said that, there's one more aspect that one should consider, and that is the pricing power. Obviously, the NBFCs which have a larger pricing power will be able to pass on the higher cost of funds. Which are the NBFCs which have a higher pricing power? It's the gold loan financiers, CV financiers, microfinance companies. On the other hand, it's the wholesale financing and housing finance companies which have a low pricing power, because especially these housing finance companies, because they already operate on very, very thin spreads as compared to the other NBFCs, and that has led to analysts preferring banks, because the primary source of liquidity for them is deposits, so it's easier liquidity. So Credit Suisse has said that they prefer banks in the current environment. Nomura has chosen to pick CASA heavy banks and rural financiers, whereas Edelweiss has turned cautious on NBFCs and they prefer HDFC and ICICI banks. So housing finance companies clearly seem at a larger disadvantage right now.
And a big no-no from almost everybody, though almost HDFC probably finds a mention here and there. But
because of the parent age, funding issues don't seem to be huge for them, so yes.